Look at a typical retail trader setup, and you will usually find a cluttered screen of neon indicators, trend lines, and geometric shades. There is a pervasive assumption in the market that an edge is derived from reading these charts to predict exactly where an asset's price will move next. Consistently extracting capital from the markets has nothing to do with prediction. Professional trading is strictly an exercise in applied mathematics and probability. To build a system that yields long-term profit, we have to engineer it from state principles by optimizing three distinct quantitative layers. Those layers are positive expected value, variance tolerance, and dynamic risk of ruin capping. Transitioning from subjective chart guessing to structural probability engineering is the only mathematical path to long-term market extraction. The core baseline metric of any profitable system is expected value, or EV. This is the sum of what a specific trading methodology returns over a large sample of executions. This formula calculates your EV by multiplying your win ratio by your average win size, then subtracting your loss ratio multiplied by your average loss. The resulting number represents the exact monetary value of every trade you take, regardless of whether that specific trade wins or loses. To increase this number, you must balance two variables that share a strict inverse relationship: win rate and risk to reward payout. As you extend your profit targets, your frequency of winning naturally decreases. We can observe this relationship through different operational archetypes. The high variance profile, for instance, targets high payouts but suffers very low win rates. A system targeting an 8-to-1 payout while winning 15% of the time yields an expected value of $170 per trade. While profitable, this profile requires sitting through prolonged streaks of losses to capture a single return. The second archetype is the low variance profile. Here, the trader optimizes for frequency, winning often but settling for a minimal 1-to-1 payout. In this scenario, by mathematically isolating EV, you realize that any single win or loss is just a component of the larger average. This removes the emotional pressure to be right on any individual trade. A positive EV only works if the system survives variance. Variance is the mathematical noise that separates short-term trade results from long-term expected value. Look at this simulation of 100 different traders. They are all starting at the same 0 point, executing the exact same profitable system. After just 10 trades, the results scatter. Some traders plunge into drawdowns, while others spike into profit. Because they followed the same rules, this disparity is driven purely by the random distribution of wins and losses. As we scale the timeline forward to 1,000 trades, the large sample size overrides the noise. The chaotic lines converge and merge into a single upward trend. Variance ensures that even a flawless system can face a 10-trade losing streak at any time. When this happens, traders often fall for the gambler's fallacy, believing that because they just lost a string of trades, a win is due to happen next. In reality, every trade is an independent stochastic event. A coin flipping in the air has no memory of landing on tails 3 times, and neither does the market. If you abandon your rules during a downswing by widening stops or chasing losses, you destroy the mathematical edge that would have eventually pulled you into profit. Systematic trading requires outlasting short-term variance rather than attempting to avoid it. Risk of ruin is the statistical probability that variance will exhaust an account's capital before the edge has time to realize its value. This matrix shows the asymmetrical math of drawdowns. A 20% loss requires a 25% return to recover, but a 50% drawdown requires a 100% compounding return just to reach break-even, effectively breaking the recovery curve. To survive variance and keep the risk of ruin negligible, you must implement a strict operational constraint, fixing your absolute risk to exactly 1% per trade. Consider these two setups. Setup A requires a wide 15-pip stop loss. Setup B requires a much tighter 6-pip stop. To cap risk on Setup A, we dynamically adjust the position size. The contract volume shrinks to match the wide distance, keeping the total risk at exactly 1% of the account. On Setup B, the math inverses. Because the stop loss is tight,
The contract volume expands, yet the total monetary exposure remains identical to setup A at 1%. Dynamic sizing decouples market volatility from your equity curve. A loss is always capped at 1%, regardless of how many pips the market moves.
Look at these two equity curves. The red line risks 5% per trade. Under normal variance, it hits a downswing and crashes into ruin. The blue line risks a dynamic 1%. It absorbs the exact same losing streaks and continues to scale upward. This dynamic mechanism protects the capital base, giving the positive EV system the time it needs to compound. Profitable trading operations do not extract capital by analyzing charts more effectively than the market. They extract capital by isolating a plus EV edge, absorbing random variance, and mathematically capping risk. These three layers form a cohesive circular system loop. Operating this closed-loop system requires the trader to follow the math strictly, setting aside any impulse to interfere with the process. Once these parameters are established, the math handles the extraction. The trader's only job is the rote execution of the rules. Long-term success is never about the outcome of an individual setup, but the relentless application of the system's probabilities.